Welcome to Bloomberg ETF IQ. I'm Scarlett Fu. Katie Greifeld is on assignment. Let's get to the biggest stories right now in the nearly $20 trillion global ETF industry. Is it back to sell America? Stocks posted early losses while treasuries and the dollar fell after the Trump administration escalates its attack on the Federal Reserve, renewing concern about central bank independence. We'll discuss the implications in moments with Rob Arnott of Research Affiliates. Vanguard, the poster child of low-cost ETFs, has been charging higher fees recently. Is this the end of the fee war? As always, Eric Balchunas from Bloomberg Intelligence is with us, and he's got a check on the latest flows. Eric.
Scarlett, thank you. So, look, it's a new year. We have our first week in the books. New year, same flows, same leaderboard. You're going to see VU at the top here, $9 billion. I mean, it just basically, I guess the great ones, they don't take any rest, right? They just keep going. VU, obviously, if we haven't watched this show, it broke the record for flows last year. It's on pace to do it again. IVV, that's also S&P. Now, emerging markets, this is interesting. This is a big chunk for emerging markets. We're going to discuss emerging markets later in the show. I think there's a lot going on there. This is international developed, more international. So international, 3 here. That's interesting. Let's see if that pans out. VTI, that's U.S., and then there's treasuries. That was on the leaderboard all last year, too. Let's look at the outflows, and you'll see at the top SPY. Now, SPY traditionally has horrible Januaries because a lot of people will use it to do tax loss harvesting in December, so they pile into SPY or window dressing. They come out in January just as soon as they went in. So you always see a big hit for SPY. So $7 billion is expected. But interesting, the ETF flows have totally overwhelmed it, which I'll go over in 2 seconds. Soxel, that's 2X semiconductors, outflows there. There's growth, small caps. We'll see, one of these years the sun will shine on small caps, but who knows when. Anyway, there's some value, LQD, there's some bonds. Nothing too much to write home about. I think the big thing here is that the flows so far this year have been $45 billion. That is a lot for the first 6 days of January, which is typically a very dull month for ETFs, a low month. Here's a history of all the Januaries for ETF flows here. You can see it's just never that much. This is a pretty good one in 18. That's $83 billion. But this was negative, 39, 58, 22. You can see it's around 40. Now, last year was pretty good, 88. This is, I think, the start of ETF mania here. This year, we're on pace for $158 billion. So completely overwhelming those SPY outflows, Scarlett. I think it's just SPY does its thing, but there's so many more ETFs and so much more activity. It's totally making up, and we're in a new normal.
All right, thank you so much, Eric. Joining our conversation now, I'm pleased to say, is Rob Arnott. He is chairman and founder of Research Affiliates. And Rob, you heard what Eric had told us, this continued inflow into U.S. stocks, even in January, where you typically don't see these kinds of levels, at a time when you've got overwhelming consensus for a 4th straight year of double-digit gains. Does that concern you? I mean, this is a pretty aging bull market at this point.
It's an aging bull market. I wouldn't chase it. I think the non-U.S. markets are quite cheap relative to the U.S. market, and for good reasons. I mean, American exceptionalism is very real, but cheap stocks and small cap also represent interesting opportunities. One fun factoid, if you look at Russell 2000 versus Russell 1000, the 2000 looking at price earnings, price to cash flow, price to book, price to sales, is trading at a little less than half the multiples of the Russell 1000. The narrative is these companies are a waste of time. Why bother with them? Okay, well, if that's true, then you should have seen faster growth for these 1,000 than for these 2,000. Over the last 30 years, the growth has been slightly faster for the 2,000 than for the 1,000 in earnings and sales. So if the growth is faster and you get it at over half off, that's a pretty good deal. Money pouring into the large cap ETFs will continue to drive a wedge between those valuation multiples. But if the growth is faster, then these will win in the long run.
Is there a sentiment issue here? Because I think for most people, and this is something I've come to, where small caps used to be like a farm league for the rising stars of tomorrow, but a lot of them wait till they're large to IPO, and the Mag 7 just seems to acquire any company worth anything. So like they get plucked out too easily, almost like when like LeBron went right to the NBA, he skipped college. Yeah. You just skip small caps now, so it's more of a dumping ground. Now maybe the data doesn't bear that out, but is that maybe the reason? There's like a psychological reason people won't buy small caps?
That narrative is the reason. And the question is that narrative going to prove out to be true? We don't know.
Do you think that small caps are worthy of the Buy America trade, or is that under threat now? All of U.S. assets under threat with the president's continued attacks on Fed independence? Well,
Fed independence I've always thought was somewhat of a myth. The governors are appointed by the president on a rolling basis, so you get this slow takeover of the Fed with your chosen people. And so the Fed independence disappears reasonably quickly during any presidential term. And the result is Fed's always been political. The notion of Fed independence, I think, has always been overrated, almost a myth.
But in this administration, it's a little bit different than what we've seen in the past.
Trump has a way of challenging norms and breaking rules. It's kind of the meta analogy of move fast and break things.
So you have a new paper out. You talk about this conventional wisdom of market cap weighted ETFs. This is an age-old debate, but obviously with VU continuing to take in money, the top two are market cap weighted. I've always thought market cap weighting was the best ideas of active, right? Because if active likes a stock, they bid it up, it gets a higher weighting, and then the indexes give it a higher weighting. And if active doesn't like a stock, it gets a lower weighting. So isn't market cap weighting the best of active? Why would I want to not hold that?
When we launched RAFI 20 years ago, we knew we were onto something important. We didn't realize at the time how important. The innovations of RAFI, that's the fundamental index, choose stocks based on how big the business is, weight them on how big the business is. What does that do? You take companies that are trading at premium multiples, you reweight them down. Take companies that are trading at deep discounts, reweight them up, so you have a value tilt. But the selection issue is very interesting. Conventional cap-weighted indexes wait until a stock's market cap has soared before they're added. That leads to a lot of flip-flops. Companies come in, then don't measure up to expectations and are kicked back out. Over half of all of the stocks kicked out of S&P or Russell are kicked out after falling by more than 2/3 relative to the market. They were first added after rising by 75% relative to the market, and you missed that. You didn't get that, and you did participate in losing 2/3. So if you can mitigate the damage done, flip-flops haven't been studied. They've been largely disregarded. But even though it's only 5% of the portfolio that turns over in any given year, that 5% has an outsized influence. The indexes look neutral, look like the market. The trading doesn't look neutral. The trading is chase frothy growth, dump deep value. And it turns out that our paper's called trifecta. Because if you can have a better growth strategy, a better value strategy, and a better core strategy, you've achieved a trifecta. Now, when it comes to core, all we do, we cap weight. All we do is we add stocks when the business has ratified or validated an earlier surge in price. Don't necessarily pay more for it. You do come in later. So we'll be a little late to the table for the next NVIDIA, but we'll miss the next Rivian or Lucid.
So RAUS is your ETF ticker. You've been in the industry forever. I have to get your take on something that I saw a couple days ago. So somebody tagged me. I went back and watched an episode of Jeopardy, right? There was a question for all three contestants about what is an ETF. And I was watching the 5 minutes before. They got everything right, including mutual fund, by the way. Nobody knew what an ETF stood for. And all these flows are coming in. So let's play the clip, and I want to get your take on like what inning we're in here, because
it's sobering.
Yeah.
ETF stands for this kind of traded fund, for the type of marketplace at which they can be bought and sold. Cameron.
What is electronic?
No. Harvey or Jason? It's an exchange traded fund.
I mean, there was another question on like what was Radiohead's album in year 2000. They knew that. They knew all kinds of like random 18th century poetry. They could not get this. What do you make of that? And are we still early?
I wouldn't say we're early. I mean, this is a big business. I would say that ETFs are the wave of the investing future, especially in the U.S. where they have that special tax treatment. they are tax advantaged. They are a powerful innovation. And, you know, this is an industry that loves to innovate. The indexing world may sometimes seem rather boring, and revolutions are going to be slow, take their time, but there's still revolutions. S&P launched the first broad market index in 1957, and they've been enhancing it ever since. MSCI launched the first international indices in 1970. They've been enhancing it ever since. It's a very cool industry.
I'm surprised that two of them didn't even attempt to guess. That's what got me.
I know.
After electronic, and then it was just blank.
I know. And the answer was in the question, or vice versa. But yeah, like I said, that happens at Thanksgiving dinner. Only like two of my relatives will even know it.
If you'd told me that tape was from 2005 instead of 2025, I would have believed you.
Right.
In 2025, it's astonishing.
It is, right?
The ETF industry has more work to do when it comes to educating the public. Rob, thank you so much. Rob Arnott of Research Affiliates. Coming up on ETF IQ, Exchange Traded Fund IQ, the fading of the fee war, why even Vanguard is getting away from their rock bottom fees. This is ETF IQ. Welcome back to Bloomberg ETF IQ. I'm Scarlett Fu. It's time for the ETF Brief, where we highlight the stories and trends that caught my eye. The SEC needs to make a decision on a filing for a Venezuela exposure ETF. Tucrim Trading filed the application last week after the U.S. ouster of Venezuela's leaders left investors eager to capitalize on new investment opportunities in that country. Now, the proposed ETF would track an index of Venezuelan-based companies and firms that get the majority of their revenue from that country. Turns out ETF adoption in Canada now rivals the U.S. Canadian ETFs pulled in about $110 billion in 2025. The funds account for about 27% of all Canadian fund assets, a level that is on par with the U.S. and a clear sign that the wrapper is fully mainstream. ETFs do still have some ground to make up in Europe and Asia. The funds only make up a tenth of all fund assets in Europe, while Asia Pacific remains a fast-growing market with adoption closer to 20%. And you remember the ETF fee war, where issuers, usually led by Vanguard, undercut each other by lowering the expense ratio in order to win market share? That era may be over, with the average ETF fee steadily rising over the past 5 years. In fact, the bottom was 9 years ago in 2017. So let's talk about this with Psarofagis of Bloomberg Intelligence, who's been writing about it. And I want to bring up Vanguard because it's usually the catalyst for a fund issuer cutting fees. But you point out that Vanguard is quietly raising fees on its new funds.
Yeah, they are. And also, to be fair, they're also going into other areas besides just like core beta. So that is commanding a higher fee. But I think symbolically, that's really important that, they've been so under this cost pressure for so much. They've dragged down all the industry. Now they're saying, okay, we can start to roll out products, maybe charge a little bit more. The pendulum is just swinging completely the other way. But cost still matters. Most of the flows are still going to the cheap stuff, but on the margin, it's starting to change a little bit.
My read on that chart of the average fee going up is that there's just no sense in launching a cheap U.S. equity ETF to compete with Vanguard or BlackRock. So people just forget that. So they launch wild and crazy. They're trying to feed the degens who are way less fee sensitive. And so the products come out are majority higher cost. And that's making the number go up. But is the asset weighted fee also going up?
No, that's still going down, which is good. But on the margin, it's starting to flatline a little bit, right? In that, everyone's only about half the flows went into products that are 10 basis points or less. That's still a lot. That's half the money. But it used to be 65, 70% of the money. But I think to your point, you're just learning to live alongside Vanguard. I can't beat them. So I need to but the good news is you don't need that much assets at a 75 basis point fee to actually be a pretty profitable firm. So I think there's a lot of interesting profitability potential for some of these new issuers.
You look at VU and the expense ratio is 3 basis points. What's the line between what's cheap and what's expensive? Is it 10 basis points? Is it 5?
Yeah.
Where is it?
That's a good question. I feel like 25 is a number that sticks in my head, but now we're at 65 basis points for an average fee.
I would say 25 for active. But for beta, if you just want I'm at 5.
Yeah, that's a fair
I think
point.
it depends on the category.
Okay.
Yeah, it depends. So active will change. Single stock ETFs are like almost 100 basis points. So it just depends how different you are, what you're offering. But beta, yeah, you can't beta should be free really, but like 3 is a pretty good level for it.
Beta, yeah, he says beta is a human right.
Right. That should be the title of your next deck. Because
it should be. It should be in the Constitution.
All right. Thanks to Athanasios Psarofagis of Bloomberg Intelligence. Beta should be a human right. All right. Still ahead, we speak to Mauricio Alvarez of OTG Asset Management on the firm's Latin America ETF next. It's been making some interesting moves. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu. Eric Balchunas of Bloomberg Intelligence is back with us now with today's drill down, where we focus on one ETF. Eric, what do you have?
Scarlett, today we have a lesser known ETF. I actually discovered this one because I was searching for a Latin America ETF that was different than ILF and had more weighting to Chile. So I did a screen, found this, and I put it on my 26 ETFs to watch for 26, which is our group's report on BI ETF, if you want to see it. This is one of my picks. It's a Latin America ETF. It's actively managed, so this is somebody who's very much on the ground there picking stocks in Latin America. 23 million, so not that big, and it's about 5 years old. 95 bips, a little pricey, but again, if you hit it big here, the returns can be pretty big. So let's look at the cross section of the holdings. I'll show you the country breakdown. Brazil is big, obviously. Brazil has an election coming up. There's this whole wave politically sweeping over Latin America, more pro-business leaders, and that usually is good for stocks. You got Mexico, Chile, that's why I said 11%, that's high compared to other ETFs, and that's why I picked this one. Let's look at the performance of this versus ILF, which is the iShares sort of Latin America, the bigger one, and EM. Everybody knows EM. Look at how good these guys are doing the past couple of years versus the rest of their emerging market peers. 50-50, right? Now, OTGL will have to be better, I think, than ILF to get more assets. We'll see. But they're both looking very good versus EEM. It'll be interesting, Scarlett, to see if Latin America emerges out of the EEM thing and gets flows on its own.
All right, good stuff. Eric, joining us now to talk about this fund is Mauricio Alvarez. He is CEO of OTG Asset Management. So, Mauricio, what is the case for investing in Latin America in 2026 when it's already seen the bulk of these gains in the last few years?
Sure. Thank you for having me. It's a real pleasure to be on the show. I believe last year was a great year for the region, as you can see, for what Eric was mentioned. But still, I think there's a more potential. Valuations are still cheap in the region. If you compare to other regions, the Latin America valuations are around 10 or 11 times earnings, whereas the U.S. is around 24, China is 23. So I believe one of the key factors will be valuations are still very compelling to invest in the region. And another aspect that Latin America is going towards is the political cycle. There were some countries who are turning from left to the right wing or more conservative wing, like Chile, Argentina, Ecuador, even Bolivia as well. And that's another aspect that can be very important for the future in investments, because there's going to be more pro-market policies or more conservative policies, and that's always good for markets.
So let me ask you this. I get the political angle. You're looking for these sort of more conservative, pro-business candidates. The markets have a long history of going up when they get elected. Are there other things you look for as an active manager within those countries in terms of valuations or any sort of innovation in companies there?
Sure. I guess there's a lot of mispriced equities in the region. It's always been like that. The asymmetry of information is huge in Latin America. So one of the things that we do as on the ETF is to focus on local companies because most of the investors thinks that when you invest in Latin America, it's just Brazil and Mexico. So on our ETF, we think that there's more to offer. So we invest in the Indian region, like countries like Chile, Peru, Colombia, where you also can find great opportunities. It's not the typical ADR that everyone invests. So the fact that we are on the ground, that's with OTG, stands for, allow us to travel to the different countries that we visit, the companies we invest in. So I think that's the alpha that we generate. Investing in these companies are not in the radar of everyone else. So being on the ground, being on the region, the whole management team is from South America.
Yeah.
That, I think, gives us an edge comparing to other managers who manage Latin America.
Yeah, OTG, or on the ground. Love that. It makes it very clear. So tell us what you see from where you sit in La Paz, Bolivia, about what's happening in Venezuela. We've told you about how Tucrim Trading is filing an application for a Venezuela exposure ETF. Is there a way to invest in Venezuelan-based companies or companies with exposure to revenue generated in Venezuela right now?
Well, right now, I would say one of the companies that has exposure is Chevron. I think we have to see what's going on in Venezuela going forward. There was a big step with what happened. I guess it's going to be one of the markets that will have a lot of future, but they have to put the house in order. We don't know how long it's going to take. This is new for everybody. So I think it's a great opportunity, but we have to see how these things will change going forward, because it wasn't an easy move, I said, but it was a very important move, and it was a very important signal through the whole region. So I believe everyone who will stay in power forever will think twice. So that's good. That's always good. And that's a good sign for the entire region.
All right, about 30 seconds left. Just real quick, I talked earlier, everybody in the U.S. tends to just buy like an emerging markets fund, and they just forget about it. How do you sell a Latin America specific fund against that sort of typical move where you just buy EM or EEM or something like that, and you're done with your emerging markets allocation?
I guess the Latin America, it's an undiscovered opportunity for any investor. The region has a lot to offer. There's a lot of opportunities. We believe that all the mispriced securities are part of it. But we do think that Latin America has a lot of opportunities. There's a middle class that's growing a lot.
Yeah.
There's a lot of lack of digital and on the banking services as well.
Sure.
So I think Latin America will have a lot to offer going forward for all those changes.
Okay.
It's a great diversification.
Mauricio, thank you so much for your time. Mauricio Alvarez of Strategic Asset Management with his fund, OTG.